So a lot of times when people talk about the labor market, they talk about the number of people who are working. But the other part of the labor market is the wages and earnings side. So there's a couple ways to look at it. In health economics, we start at what's called the wage. The wage rate is some price of hour per working, okay, or price of hour paid for working. And most people don't get paid on an hourly rate, or I guess it depends, but a lot of people get paid on hourly. A lot of people get paid on a yearly. But in general, the yearly can be divided by the number of hours that are worked or that you get paid for, and so forth. So the wage is the main unit of measure that we use. So there's two ways to look at it. There's the nominal wage and then there's the real wage. The nominal wage is how much gets paid in current dollars. This is used for comparing wages at any given time. Okay. If you think about how much you make at your job right now, that's what your nominal wage is. Oops. Not nominal wage. Let's change that. Nominal wage. And the real wage, on the other hand, is the nominal wage divided by some measure of prices. And what the real wage does is it allows you to compare apples to apples. You can compare wages to between different years and between different geographies, okay, different locations, countries, so forth. So if you think about it, you know, a nominal wage, compare nominal wages, if you said someone was making $5 an hour in 1930, you might think, all right, well, that's not a lot. But in reality, that's significant. $5 in 1930 is a lot more than $5 today. So in order to be able to compare it properly, you need to get the real wage. And so the real wage, it's a good way to look at purchasing power. So how much can you purchase with it? How much can you buy with that money? It's usually the CPI, Consumer Price Index, that's used to determine the real wage. But again, it's a good way to compare apples to apples. So earnings. Earnings is, so you have your wage, that's how much you make in a year. Your earnings is going to equal whatever your wage rate is times the time worked, the number of hours worked. Okay. So it's the total amount of money you get in some set period of time, whereas wage is how much you get in just, you know, one unit of that. So you have your wage, you have your earnings, your total compensation. Your total compensation also figures in some other non-monetary type payments that you also receive. So if you get, for example, paid time off, or you get health insurance, life insurance, so forth. So all that has a dollar value with it. You don't actually see that dollar value, but it's included in part of your compensation because it's something of value that you're receiving. So the total compensation is the sum of all payments you receive and the benefits that you receive. Now, everyone can also earn some unearned income, and so you can get income through tax credits or food stamps, welfare, housing vouchers, and so your total income is going to equal your total compensation plus any unearned income. And that unearned income can include the government transfer programs, or it can also be if you own stock, for example, you might get paid dividends on it, or you could get paid interest from your bank account. So all that total money comes from, you have your earned income or your labor income, then you have your benefits, so you have your total compensation plus your unearned income. So now we're going to look at the different markets and how a labor market works. And when we are looking at different markets, you have goods markets and then you have what are called the factors markets. So there's really three markets what you can look at. The first is let me get this up here. So the first is the product market. Oops. And let's do, okay. So we have the product market. And within the product market, you have goods and services being exchanged for money. And this is what most people think of when they talk about the market. They talk about, I go to Best Buy and I buy an iPad. And so you give money and you get the iPad in return. Well, to get that iPad in your hands, which comes from the firm, you also have two other markets. Okay, that iPad needs to get made and sold to you. And so we consider in this course at least, goods and services can be provided using two inputs, two factors of production. The first is capital and the other is labor. Okay. So here in the product market, people, individuals, are the buyers and the firms are the sellers. In the capital market and labor market, however, the firms are actually the buyers or the renters. So you have the suppliers of capital and the suppliers of labor. And in the capital market, the people who own the capital, they sell it or rent it out, lease it out to the firms, and the firms pay them rent in return. And then we have the labor market. In the labor market, the suppliers' laborers, or the individuals who are also the same consumers, and same with the suppliers of capital who are the consumers as well, in another aspect. But in the labor market, the suppliers' labor, the individuals, they are selling or realistically renting their labor, and in exchange they get paid wages. And so what you have is the firms, they're taking money and they're sending it to the suppliers of capital and suppliers of labor to give that labor and capital so that they can produce those goods and sell it to the firms and get money in return for that. And so in these markets, we have a lot of money that's going around and around and around and so forth.